Amidst the echoes of traditional voices expressing concerns about recession and depression in today's world, Jim Rickards presents a distinctive perspective that defies the conventional wisdom. In this video, we delve into his unconventional insights on the current economic scenario, unveiling an alternative pathway that has the potential to reshape our comprehension of the financial landscape. Take a moment to absorb his thoughts, and later, I'll elaborate on the reasoning behind his unique viewpoint.
My view is that the world has been in a depression since 2007 and will remain so for an indefinite period of time. And when you say that, people are, wait a second, we know the definition of a recession. The technical definition of a recession is 2 consecutive quarters of declining GDP, rising unemployment. There's a few other bells and whistles. There's a little bit of subjectivity to it. The National Bureau of Economic Research are the unofficial but widely followed referees on when you're in a recession and when you're not. Well, we're in an expansion. So like, wait a second, how could we be in a depression if we're in the 10th year of an expansion? And the answer is that people don't really understand the definition of a depression. They assume intuitively, well, if a recession is 2 quarters of declining GDP, and depression sounds worse, it must be 6 quarters of declining GDP. Well, we haven't had that. But that's not the definition of a depression. The definition of a depression is a sustained period of below trend growth with no particular tendency to collapse or getting back to trend. In other words, I'll use the United States, but you can apply this more broadly to the world. If trend growth is 3.5%, and that's probably the long-term potential of the United States, you can higher nominal growth with inflation, but we're talking about real growth. If trend is 3.5, and you're running at 2, that gap between, say, 3.5 and 2, that's depressed growth. So yes, you have growth. You're not in a technical recession, but you're in a depression because you're not getting back to that trend. And people say, well, 2%, 3%, it's 1 percentage point. Who cares? No, that gap is huge. And because of the compounding effect, think of it as a wedge. Here's the trend line. Here's the actual line. That wedge gets bigger. So we're 10 years out. We've left $5 trillion of potential growth on the table. That's the output gap or the growth gap, the difference between depressed growth and trend growth. That's how much wealth has been lost because of this depressed growth. But being objective, using the numbers I mentioned, we're in a depression. We're going to stay that way. The United States is Japan. Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their 3rd lost decade. If something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, oh, well, the headwinds, demographic, technological, productivity, psychological, etc., haven't changed, and there's no reason to expect they'll change. So combine this world depression, because what I just described is true of Japan, that's true in Europe. Not so true in China, but China's a special case. There's a lot of, they cook the books. They're 7-8% growth that they've been printing. Cut that in half because 45% of that growth is infrastructure, most of which is wasted. So if you apply generally accepted accounting principles and made them write off all that wasted investment, they'd be a lot lower than it appears. But the whole world is caught in this trap. Meanwhile, debt is going up faster than the growth. Is debt good or bad? Well, it depends. Debt can be good if you can afford it, if you can pay it off, and you can use it for productive purposes. It's bad if you can't afford it, it's not sustainable, you're using it as a substitute for real growth, and it's all going to crash and burn. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I spent a lot of time looking at, the GDP is kind of chugging along, not going up very much, but debt's going like this. The debt to GDP ratio is getting worse. It looks like we're heading for a global debt crisis. Not quite there yet, but it could happen sooner than later.
In a world where traditional economic indicators present a perplexing picture, Jim Rickards introduces a thought-provoking perspective that contends the current state might be better characterized as a depression rather than a mere recession. With inflation on the rise, unemployment hitting historic lows, and central banks elevating interest rates, the question of navigating a potential recession becomes increasingly relevant. Yet, the conventional solution to combat inflation, raising interest rates, poses its own set of challenges. The delicate balance at play is now a focal point in economic discussions. Jim highlights emerging ominous signs in the global economic landscape, citing concerns over escalating living costs, surging interest rates, and a declining consumer confidence that could lead to reduced spending. Navigating this economic equation seems precarious, prompting many to ponder if a recession is inevitable. To curb soaring inflation rates, interest rates would need to rise significantly, potentially around 10%. Jim emphasizes that a real interest rate of 2% or more is crucial to effectively combat inflation. However, the likelihood of the Federal Reserve raising rates to such heights appears remote. Jim argues that such a drastic increase in interest rates is improbable, as it could trigger a severe recession and a substantial market crash. Even the Federal Reserve, as indicated in a recent statement by Jerome Powell, acknowledges its intention to avoid causing a recession despite the pressing inflation dilemma. This puts central banks in an incredibly challenging position, as Jim suggests that inflation will only subside when rates reach a sufficiently high level, but achieving such high rates could inadvertently cause a recession. Jim is not alone in expressing serious concerns about the health of the global economy, particularly the U.S. former United States Secretary of the Treasury, Larry Summers, underscores the historical data that does not bode well for managing both low unemployment and high inflation without eventually leading to a recession. Summers points to the historical correlation between low unemployment, high inflation, and an impending recession, highlighting the challenging task for central banks to engineer a soft landing and curb inflation without triggering an economic downturn.
The baseline scenario for the Fed is straightforward. They're going to tighten 4 times a year, every March, June, September, and December, unless one of 3 pause factors applies. The pause factors are disorderly decline in stock markets, employment starts to go down, they basically lose jobs, their unemployment's going up. The third one, disinflation or deflation spins out of control. Right now, none of those 3 pause factors applies. The stock markets, they're going sideways, but they're not crashing. The Fed doesn't care if the stock market goes down 15% in 6 months. They do care if it goes down 15% in 6 days. That's disorderly, and that's the kind of thing where you would see the Fed pause, but that's not happening right now. Job growth is strong. Inflation is ticking up. I don't think it'll spin out of control, but we're out of that disinflation danger zone. So none of the 3 pause factors applies. Therefore, you should expect the Fed to just keep raising. But there's no doubt that the Fed is over-tightening because in addition to trying to get interest rates back to normal, they're also reducing the balance sheet. They're trying to normalize the balance sheet. But now the Fed has a dilemma, which is what are they going to do if the U.S. economy goes into a recession? And history shows that it takes about 4 percentage points of cuts, 400 basis points, in other words, for the Fed to get the economy out of a recession. Well, how do you cut interest rates 4%? The answer is you can't. You cut them to 0 and then you're stuck. You're at that 0 bound. And the evidence is good that negative rates don't work.
The U.S. debt crisis, often overshadowed by political disputes, is a ticking time bomb that should concern every American and extend far beyond its borders. While the recent debt limit deal may have temporarily postponed the inevitable, the core problem persists, and the nation's debt is spiraling into perilous territory. To grasp the magnitude of this issue, consider that the debt ceiling debate essentially revolves around how much the U.S. government can borrow to meet its financial obligations. Since 2001, the U.S. Treasury has been relying on borrowed funds to sustain its operations, consistently operating with an annual deficit, covering a substantial portion of expenditures through credit. As the U.S. engaged in an increasing number of foreign conflicts, its debt began to surge. Since 1960, Congress has raised the debt limit 78 times. Over the past 2 decades, the U.S. has amassed an astounding $25 trillion in debt, primarily to finance wars, tax reductions, emergency responses, and expanded federal outlays. Currently, the United States bears the burden of being the 4th developed country with the highest debt-to-GDP ratio, trailing behind only Japan, Italy, and Greece, closely followed by Spain. A U.S. debt default is often referred to as the mother of all crises, due to its potential to unleash a devastating chain reaction worldwide. However, the debt ceiling standoff has devolved into a dangerous game of brinkmanship, with both the Biden administration and congressional Republicans daring the other to flinch and avoid a catastrophic default on federal government debt. The economic data paints a grim picture, and the stakes are higher than ever. It's not merely a political standoff, it's a battle against financial instability that could reverberate across nations. The world is watching as the United States teeters on the precipice of a debt crisis that could reshape the global economic landscape.